Good morning, good afternoon, in a word. Welcome to Natixis Outlook for 2023. We are very happy to welcome you in this now kind of traditional session of trying to give you our views for the next 12 or 18 months. As usual, this is very difficult to do any forecast, but we say that every year. So this 2023 is no different. So what we are going to do is a little bit a new format for us. We decided to do 3 sessions, so 2 in English, 1 now. We're going to be focused more on the US economy, Europe, obviously, energy, first thing first. And later this afternoon, another English session with a bit of a more focus on Asia and China especially, and still in Europe, in the markets, and energy as well. In the meantime, a French session at 11 a.m. Please, as usual, use as much as possible the Q&A session, the Q&A button on your screen. That's a good thing about being remote, at least, to be able to try to answer your question. On our side, we have decided to focus, as usual, macroeconomy and then market and what could be a good asset allocation in this context. Obviously, the name of the game is still energy, so we are going to talk a lot about energy. The question is not about if we are going to see a recession, but by how much, in a way. That's probably the big question mark. How deep is going to be the recession, but a recession will be. That's a big question we have to discuss. In our view, it's more like a stagnation. You will see that we forecast a mild recession, more the true big recession like 2008 or a true big slowdown of economy. Having said that, once again, probably it's a big slowdown ahead of us. The second point we have to discuss is inflation, as we see that the rates are doing the markets, and who is doing the rate? Central banks, and central banks are led by inflation, first thing first. So if we want to see where inflation is going, we need to discuss energy as an introduction. That's something we will be doing. But just to give you the big picture that we have within Natixis research, it's a global slowing down of the economy, close to 2% for the world economy. Quasi-equivalent slowing down between the US and Europe, and we are well below 1% of GDP growth, so US is no exception on that. Europe obviously is at the core of the energy crisis, so it is much impacted. And maybe the only contrarian economy will be China, and China was decelerating fast, while the rest of the world was doing very, very well. This year, Europe is going to be close to 3% this year of GDP growth, so well above its potential. Think of France, for instance. We are going to be above 2.5. Potential GDP of growth is 1.2 for France, so it's twice as much. So a very good 2022 year. We were thinking that it was going to be a very, very difficult year with the war, with the energy crisis, all these bottlenecks. At the end of the day, it's a very good positive year for Europe. Much above US, by the way. And the only exception to that was China. China is in the middle of the zero COVID crisis. And on top of that, on this story of the real estate, all these bubbles that we see. So this year, China will be not much than 3% in our view. The big question is what's happening next year for China. What we do see, and we are revising upward, in fact, our GDP growth, and we just did that, and we were thinking something a bit above 4% next year, but we can easily think of something 5.5 next year for China if this reopening that we see these last few days is there, and that's a bit of a game changer, probably for energy prices, but probably for Europe as well. I'm thinking of Germany, for instance, a big exporter to the US. So something is going to change, as you know, and China is 1/4 of the world energy import. So if China is restarting fast, that's a game changer. It's going to make life a bit more difficult for LNG buying from Asia to Europe next year. So we will discuss that. But the big picture, to summarize and to start the discussion with my colleagues, for us, it's a big slowing down for sure. Once again, you can see the number from 3 to below 1% in Europe, from 2 to below 1% in the US. So big slowing down everywhere, but in China. But this is more a mild recession. close to a stagnation at the end of 2023. We will be still a bit above 2022 level. So it's not a strong, and it's a temporary factor. If we think 2023, probably Europe will be again up toward its potential GDP growth, US toward 2, Europe toward 1.5, China toward 4.5. So 2024, it's another rebound coming. So it's not a big, nasty Armageddon-style scenario that we are seeing ourselves within Natixis. Without further ado, I would like to introduce my guest speaker. I'm very happy to have all my colleagues from abroad. As you know, Natixis Research is a worldwide research, and we have 20 different nationalities all over the world. So we have some good speakers today, starting with Joel Hancock. Joel Hancock is our specialist on energy and commodities. He's among the best free forecaster in the world for oil and on gas. So I think we thought it was interesting to hear from Joel on what's going on to analyze the energy crisis and what could be the future of Europe. We have Dirk Schumacher. Dirk Schumacher is the head of macroeconomist for Europe, and we have Benito Berber, our chief economist for Americas, to discuss energy, Europe, and US economies and Latin America, if any question on that. To start with, Joel, so are we going to go through this winter with gas, or is it the start of a big, lasting energy crisis?
Yeah, so I think it's probably fair to say that almost everything has gone right so far for the European gas market this winter. I mean, when we start looking at fundamentals on the demand side, I mean, one of the most influential factors has been weather. So the temperatures in Northwest Europe through October and the first half of November were actually 4 degrees above seasonal norms. And when we consider the fact that about 60% of gas consumption over the typical winter months from residential heating, that's been really meaningful in terms of the overall demand trend. Then as well, when we sort of weather correct our demand data, so strip out that impact of milder temperatures, we're seeing quite a large economic turn down from households as well. So effectively higher bills are reducing consumption in that respect too. So net, we're actually expecting to see consumption down about 23% compared to the 5-year average over the entire winter, which is quite substantial. Then when we look at the supply side, the kind of zero COVID policies in China have really reduced spot LNG demand in Asia. So effectively, the competition that we thought would re-emerge over the winter for marginal LNG cargoes effectively hasn't occurred. And so that's meant that Europe has quite a large LNG increment, and it's been able to maintain those high imports. So net, things are looking a lot better than they were at the start of the winter. And our base case view is actually that we end March, the end of the winter, about 48% fullness in terms of inventory.
We see that the stocks are full in gas. Does it mean that next winter will be easier to deal with that? Because we know that Russian gas was 40% of the import for Europe. It's, I think, down to below 10%, something like 8% today. So we are much less dependent on Russia, but still we made up a lot of our stocks ahead of the embargo with Russian gas. What does it mean for next year without Russia? Can we do it?
Yeah, that's exactly the problem really for next year, because the gas market is effectively cyclical and iterative, which means that every single summer we have to build up inventory again after drawing it down in the winter period. And as you alluded to, without Russian gas, that's going to be harder next year. So we only really had meaningful Russian flow cuts in June of 2022 with the Nord Stream 1 cuts. So we actually had 5 months of flow-in Russian supply, about 180, 200 MTM per day to Northwest Europe. We're not going to have that this year. We're effectively going to enter 2023 with 0 Russian inflow. So that effectively is going to be a supply deficit that the European gas market is going to have to offset by optimizing both the supply side and the demand side. So we're going to have to continue to curtail consumption and also attract marginal supply as well. Now, another problem is if we do have a re-emergence of spot LNG demand in China with reopening, that could also kind of add more competition and result in, the kind of willingness or need to compete for those cargoes. So really, we do expect a higher price level to be sustained next year, given the fact that we can have to continue to offset that supply deficit from Russia. So our base case view is for TTF to average about 130 to 140 euros per megawatt hour in 2023, so not too far away from where we've been this year.
So it means that the peak in a way is behind us, because remember that the TTF prices went up to 340, something like that, during the summer. So we are far from the top, but still we are far from the normalization. I think gas prices before the crisis and the war was around 20 for the TTF. So obviously this is a normalization, and we discussed that with Dirk just after, but with a major basis effect on inflation. If gas prices comes from 340 to 140, and if we'll talk about oil in a minute, same story. Yeah? We are well below where we were at the peak of the prices during the war. So somewhere down the road in 2023, big deflationary factors. How do you see next year? Because we see this tremendous, losing my ear. We see tremendous diversification, the acceleration of renewable energy. We have seen a lot of problem with nuclear in France as well, which starting to be a bit better. Only 20 reactors are off the grid compared to 32 during this winter. How do you see next year in this context of no Russian gas, maybe a bit more demand from China for 2023? Is it going to be much better than this year? Is the peak behind us?
Yeah, no, exactly. So we think we have to maintain this higher price level for European gas, but effectively some of the dynamics that were at play in 2022 won't be as meaningful in 2023. So effectively, the forced buying that we had in August, that's not going to be quite so influential. And so again, we think this sort of mild kind of persistence of the price level is going to be there, but not the spikes that we saw in 2022.
A word on oil, maybe to do the transition with inflation forecast by Dirk. What about oil in this context? And we see a lot going on with the cap to Russian oil. We have seen that again, the peak from 140 to 80 today. What's your forecast for next year, Joel?
Yeah, so at the moment we sort of view the oil market as being cyclically weak but structurally strong. So generally we'd consider oil to be one of the commodities most exposed to the macro. The weak outlook in the West in terms of the recessionary concerns, and also the China lockdowns have weighed a lot. But we do think the supply side is supportive. One of the biggest drivers of actually lower prices in the second half of 2022 was the large-scale strategic stockpile release from the US, about 180 million barrels since April 22. We don't think we have the capacity to actually release that much volume in 23. When we actually look at flow-in production, it's relatively weak in terms of its growth outlook across the US tight oil and also OPEC as well. When we add in the potential to lose Russian barrels too, that's going to tighten the supply side. So our view is as soon as we do see an acceleration of the demand side, it will expose that tight supply side. So effectively, what we're going to see is tightness re-emerge in the second half of 23, and that will result in higher prices. So we expect a couple of quarters of relatively kind of modest or weaker oil prices, but then we see the second half of 23 averaging above $100 per barrel.
Thank you, Joel. So what does it mean for Europe? We talk a lot about a big recession in Europe, especially Germany. So some of our competitors are forecasting big recession. Is it the case for Europe in your view?
Well, we're forecasting a moderate recession. That means 2 quarters of negative growth, 1% contraction in total, but then a rebound in activity. So for the year as a whole, next year or 2023, we have 0.3. It looked like a big recession at the beginning, but what argued against it in the end was that governments were then quick to intervene to support the economy, to support private households, to support corporates. And that, in fact, European exporters were also able to raise their prices significantly. So the income shock was buffered as well by the fact that Europeans made their customers outside of Europe pay more. So a recession, I think, is still the baseline, but it's not going to be a deep recession given that governments are intervening in a very meaningful and aggressive way. To be sure, there's some uncertainty whether that money will reach everybody in time and exactly who needs it most. But the numbers put on the table are big enough to shelter the economy against the mother of all recessions, which you could have expected given the size of the energy shock.
Hard to expect a recession in Germany when you put 200 billion on the table. I guess if you're freezing prices, it's a thing. And what about inflation in this context of big budget activity from the government?
Well, the most important drivers of inflation were obviously energy and the supply chain bottleneck. So if Joel is right, and I have no doubt about that, then we should have...
It was about right for the last 2 years, exactly. So let's try to hear.
Much better than I was, to be sure. That would imply that the energy contribution to inflation should fade out during the course of next year, which means from around 4 percentage point contribution now to 0 by the end of the year. So that takes away already from the 10% inflation we have, 4 percentage point, we get to 6 very mechanically. And equally important, the supply chain problems, which have pushed up goods prices significantly, those problems should get smaller, and the news out of China, I guess, support that case. So a recession, less supply chain problems, lower energy prices, if you put all that together, we should have seen the peak now in inflation during the fourth quarter, and then a gradual decline throughout next year. Of course, any new energy shock will derail that story, and we have again another peak in inflation. But if that's true, what we assume here is conditional forecasts, then the peak is behind us.
In terms of inflation, what will be your forecast for end of next year, inflation in Europe?
Well, we have around 3% by the end of next year, and then in 2024, by the end of 2024, around 2%, which is the ECB's target.
You see, Dirk used to work for the ECB, so it's very much like a central bank view. Maybe a question for you, because we see that at the end of the day, we see a lot of, Joel was mentioning that, a decline in consumption of energy, very impressive, especially in Germany. We are talking about double-digit figures, decline in energy demand. Is it a sign of a big recession, or a sign of a much more consciousness regarding saving of energy? Because we see industrial production revised upward at the end of the day in Germany or in France, quite surprisingly.
There's a lot of more saving, more efficiency going on, substitution away from gas to other sources, but at the same time there is in the chemical sector a big decline in output. We see that. So there are limits how far you can go with in terms of efficiency gains and all that. So it's a combination of both. Obviously, the good news is that the longer it takes, the more used, if you will, the industry will get to all that. And the light at the end of the tunnel, if you will, is renewables. And Joe alluded to that as well, that renewable energies are cheap in the end. It will take us a long time to get there, that's for sure. But the whole story about deindustrialization is in the end a story about how quickly can we ramp up renewables in order to replace gas and coal and oil.
It alludes to a question we just have regarding the SHIFT project. We just issued a very catastrophic scenario regarding gas if war continues for Europe. And you mentioned it, Dirk, a quite impressive shift towards the renewable energy. I think for Germany, for electricity, it's now 54% of electricity is done by renewable energy in Germany. Just giving a bit of a sign that Germany is exporting electricity to France. It's impressive. A country like Spain, it's 57% of electricity is done with renewable energy. So we have a major shift to. So it's not everything being equal. To answer maybe the question, I don't know if you want to answer that, but Russian energy, it was 12.5% of all energy imported in Europe. It's now below 2%. So we have a massive diversification and a massive acceleration of the history regarding the transition. How long does it take to transition toward much cheaper energy, which is wind and sun and water? How much of that and how long does it take? That's probably the big question, but I don't know. What do you think, Joel? Is it? I don't know if you heard about this SHIFT project scenario of Armageddon style for energy in Europe. 2 minutes. We are a bit beyond schedule.
Yeah, so I think, I mean, we always look at the REPowerEU plan as a guide. And when we do look at the kind of assumed gas production by 2030, we're looking at over half in terms of the reduction compared to the 2020 level. So it's clearly a policy, I guess, a policy point to really just try to diversify away from Russian energy by the green transition. We think that ultimately it's going to be a couple of years before we have the associated infrastructure in order to fully diversify away from natural gas, but ultimately that is the direction of travel.
We see things are moving fast. Just an example in mind is that the LNG terminal that we were saying, it takes 3 years to get one for Germany, which a non-LNG terminal, so it was going to be a nightmare for many years to come. Germany just built one in 180 days, and 7 are coming into next year. So I think Europe, it's quite sometimes and quite often slow, but this time we see a little bit of an answer for some country. Maybe turning to the US with Benito Berber, our chief economist for the US. What about the US? Because we see this is an energy crisis. We see it's a big story for Europe, but surprisingly, at the end of the day, Europe is doing maybe better than US this year. And next year, US is in a recession as well, in your view?
Well, we're not there yet. It's very interesting what's happening with the contrast between leading indicators and coincident indicators. So if you look at the subcomponent of the leading indicator of the conference board, it's below 80. That's associated generally with a high probability of a recession. At the same time, the numbers that are coming out are very, very strong across the board. Manufacturing, durable orders, retail sales, all of them are coming out very strong. So our view is that the economy will decelerate sharply in the first half of the year, but will probably rebound in the second half of the year. So specifically what it means for GDP forecast is 1.8 for 2022 and 0.6 for 2023.
Yeah, so it's again a mild recession or a big deceleration, but no big recession. At the end of the day, 2023 GDP levels will be higher than 2022. And what about inflation? Because we talk a lot about energy crisis once again in Europe, but we have seen that inflation numbers in the US were almost par with European ones. How do you see inflation? We start to see the peak now in the US. It's maybe behind us?
Yeah, no, I think we already saw the peak in June with inflation slightly above 9%. So I think it's going to end the year slightly above 7%. And then it will sort of converge to 3% by the end of 2023. And we only see inflation coming down to the target sometime in 2024. And just very quickly, I think the drivers of inflation are going to be, first of all, the moderation of economic growth, but also rent prices that have been going up very strongly. They will start to moderate next year. They follow with a lag home prices, which are falling down very rapidly. And of course, energy is going to be a big factor, and to the extent that there's going to be a base effect on energy prices, that's going to help inflation to come down fast.
And what about the Fed in this context?
Well, I mean, I think it's not a surprise. I don't think we're saying anything exciting, that we're expecting 50 basis points in December and 50 basis points in the first meeting of 2023. I think the Fed has done an excellent job in terms of signaling that it wants to lower the pace. But I think sometimes the market forgets the other message of the Fed, which is that it wants to raise the terminal rate from what it's communicated in September. And what it communicated in September was a terminal rate just slightly above 4.5%. So I think that we should think of a terminal rate closer to 5%, which is our call.
But it means that anyway, the Fed has done 4/5 of this move, so it's a major increase of rates in the US, and same as for the ECB. Never before the ECB has done 200 BPs in such a short period of time. But it means that in the US, we are probably pivoting in a way, Benito. Another question for you, which is very, very popular in Europe, maybe less in Asia, but there is a lot of concern regarding the IRA, the Inflation Reduction Act in the US. Do you think it's a game changer for competitiveness? Is it the start of a trade war between Europe and the US? How do you see that?
Yeah, I mean, the first thing I want to say is that it's a very fluid situation. The law has been passed, but the application of the law, it's something that the Biden administration is working in order to lessen the impact to its allies, to the Europeans. I think the way the subsidies work towards the green sector and the electric vehicle sectors basically exempt Mexico and Canada, which are obviously the trade partners of the US. But I think the Biden administration is very open to carve out exemptions that will include allies such as Europe. So I think that that is the process that is happening right now. We'll see what happens.
well, music to European ears if this is the case. But the good news is for the planet is that the US is at last starting to catch up the move. Maybe a question, as you are a specialist as well of LatAm. We see a lot of things going on with Lula back in Brazil. We see a U-turn of the US regarding Venezuela. What's going on there? Are there any winners, losers? What do you see next year or for the next few years for LatAm?
Of course. Well, with respect to Venezuela, I think the lifting of the sanctions, I think it's the start of a process. But what it means to the Venezuelan economy, I think it's going to take a long time to have a big impact. I don't see the Venezuelan economy going to pre-Chavez levels in decades.
A bit more of oil for the world economy?
Yes, exactly. I think that is the main reason of why the US is lifting the sanctions. In terms of the two biggest economies, I think Brazil will probably, the discussion there is about fiscal responsibility. Ultimately, I think Lula will be pragmatic. And I think Mexico will be the big winner next year. It will benefit from the geopolitical conflicts between the US and China. So it's very well positioned to take advantage of that.
Thank you very much, Benito. So you see in a conclusion, and you see a lot of slides behind on your screen. We are going to publish all these slides in a publication this week on the Outlook 2023 with a lot more slides and details. So you will see that on your email boxes at the end of this week. Maybe to conclude in a way, and if you have some question, and do not hesitate to put there here, we will try to answer it. As you can see, once again, it's not a very big recession that we are seeing in our scenario, be it in Europe and the US. It's more something of a strong deceleration, a mild recession, as Dirk mentioned. And the reason for that is numerous, but probably what Joel was mentioning, we are far from a normalization for energy prices, but probably the peak of the energy crisis is behind us, which is something a bit not contrarian view to the consensus, but once again, we are far from the consequence, the shift project that the question was mentioning. Maybe a question for you, Dirk, and after that we wrap it up. What is the consequences? But we are going to discuss that in the panel after that. But what are the consequences of the start of the QT at the ECB in this context? Is it going to accelerate the slowing down in the tightening in the financial condition and decelerate further the European economy?
Well, it's interesting that the market, must expect it by now, but it hasn't really moved rates much. That said, there could be a recognition lag, and sometimes it takes a bit longer. What it does, it means that the ECB is now tightening along three dimensions, not just policy rates, but also TLTRO repayments, and also QT. What the mix of that means for financial conditions ex ante is very difficult to say, but all else equal, it obviously means tighter financial conditions, and say the tail risk that something goes wrong in the periphery increases all else equal.
Are we able to say how much of a rate hike is equivalent to a QT?
Well, it depends a bit on how quickly it happens, I would say. I would hesitate at this point to come with specific forecasts, I must say. It matters a lot, and usually QE happened at announcement, and the risk is obviously that once they announce it in December, at the December meeting, that the markets all of a sudden reprices very quickly things, so it may not be a smooth process, and that's something the ECB has to keep in their minds when they formulate how they're going to do it.
So it's a reason why we forecast this very low 2.5 terminal rate for the ECB, despite this high number of inflation. It's not only nominal rates; it's a whole financial condition which are already much tighter. Okay, thank you very much, gentlemen. It's a very good transition for the next panel. So thank you very much, gentlemen. We are moving to markets and central banks and banks in specifics. Thank you, gentlemen. So now we are going to talk about markets, about rates, about central banks, about asset allocation, and about banks. So I have the pleasure to welcome Cyril Regnat, or the head of market research, Florent Pochon, or senior cross-asset specialist, and Samy Lakhdari, who is our banking analyst. Maybe to start as a kind of a top-down exercise for the market, starting with the central banks probably. Cyril, what are our scenario for the ECB? We mentioned that with Dirk a bit, but what are our scenario? Can you specify a little bit more scenarios for ECB and Fed?
Well, as said previously, we were expecting ECB to hike up to 2.5%, while the market is still expecting deposit rate to end up around 3%, which in this context will have, of course, quite an impact in terms of yield forecasting into next year. But I think the big elephant in the room between now and the end of the year, or we could even speak about this week, is probably in fact the TLTRO story, because in this regard, we are talking about a huge excess liquidity reduction for Europe. This year and into the next as well, talking about a 1.8 trillion euro additional reduction in the ECB's balance sheet, which is in the end way bigger than the one we're going to have in the US, due notably to the Fed QT.
So this is not, again, we're back to what we just said, which is probably explaining why we can expect a 2.5 terminal rate. Is it something credible to have some, I don't know what our forecast for rates are, but if we have a 2.5 terminal rate for the ECB, is it fair to assume that the Bund or the BTPs are going to be below that level?
Well, situation has been pretty interesting this year, and I think Bunds are so low in terms of yields, mostly because swap spreads, so the gap between swaps rates and of course Bunds is pretty wide. Still, as of today, it's been tightening as of late, and one of our key view for next year is that this tightening of swap spread is very likely, in fact, to continue. So the gap between swaps and cash will tighten, though we don't expect any big rally, because one of our key views as well is that the US bond market will keep appreciating next year, so US yields are going to fall by another 60 BPs next year. So our target for the 10-year USD will be 3% by the end of 2020.
As opposed to for the Bund for next year, end of next year?
Around 1.85. So stability will be the name of the game, according to us, for German Bunds into next year.
If we can summarize, what your main calls for 2023, Cyril?
Well, we like steepness because, well, now that everybody is expecting the Fed and the ECB to be done by the end of the first quarter of next year, it makes sense, in fact, to have a huge resteepening. Another thing we like, of course, and I've been mentioning it, is the tightening of swap spread. Linkers are probably a bit too rich at the moment, and we do believe that notably break-even should be tighter somewhat, or if they are not, something is probably missing in terms of ECB's credibility. And last but not least, we like wideness on sovereign spreads on the back of two things, QT, of course, and the TLTRO repayments we're going to have. So we are quite negative, not only during the first half of next year, with a target for the BTP Bund around 240 BPs.
Yeah, it's very interesting because we mentioned that with Dirk, that the fact that Europe is spending a lot of money to buffer this energy crisis, and 200 billion for Germany, we're talking about 100 billion for France, more than 50 billion for Italy, so it's a lot of stress on public finances. Is it a concern? A lot of non-European investors especially are still a little bit cautious regarding Italian BTP, you mentioned that. Is there any case for a return of a sovereign crisis in Europe with this huge amount of public money, and you mentioned swap spread. Is it something credible to see with QT, with slowing down of economy and big spending by economies? Any stress to swap spread?
Thank God the EU is here and will keep probably giving cash to Italy. So as long as we have this very strong political commitment in Italy, I think that the situation on a global basis should be rather stable. Reason why, after this peak around 240 BPs, we expect a retightening of Italian BTPs against bonds toward 200 basis points. So no sustainability issues seen over the next year.
Well, we have to keep in mind that when we talk about Italy, you have 190 billion of European money to be disbursed to Italy, as long as they apply by the rules. So it makes the current government a little bit more pro-European, probably, and moving along the European guidelines. So obviously, we are not that concerned about that. Maybe moving to Florent. Thank you, Cyril. We see a very special year, and that was the worst year for equity markets since 2008. I think that's the first year ever that we have seen a bond market down by more than 10%, and at the same time, stock market down by more than 10%. What about 2023? Is it going to be a bit quieter, or is it something back to the volatility?
Well, I think it's going to be a bit better, obviously, and hopefully. And this is in line with the macro call we are having, that no deep recession, but it's going to probably not be easier. And I think it's going to continue to be a tricky year for equity investors. And well, basically, I think, it has been, as you mentioned, a terrible year for both bonds and equities, because it was really a global macro years. I mean, all the themes the market have been playing are macro themes. And basically, we had many surprises. And what I show in the slide is that normally when you have big macro surprises, they tend to persist in time. So we had big surprises last year. Probably we're going to have many more in 2023. So this means that probably the market will continue to react to these surprises. Obviously, the three themes remain. So you have inflation, we have central banks, and we have growth. And as we mentioned, we probably think that these themes have all matured. Basically, inflation, the peak is probably reached. Central banks, I think the market is pricing pretty well the terminal rates.
Pivot, yes.
Exactly. What is a bit more, let's say, not in line with the central bank speeches is the fact that they don't really buy the higher for longer. But I think the key themes in next year will be growth. So it will be growth both in macro. We discussed the theme in macro GDP growth, but also in earnings expectations. So given the background, we think that we don't have to expect a lot of EPS growth next year, both in Europe and in US. So there will be details in the publication. We have top-down models. We try to forecast it, and basically our forecast is that there will be 0 growth for EPS of the S&P next year, and it's going to be 2% growth for European stocks. So it's going to be a lot of macro themes again, inflation, growth, and central banks, and with no EPS growth. So it's probably going to be choppy, and probably as we show here, the market has been riding very, very fast over the last few weeks.
Yes,
so I'm not sure it's going to be very sustainable.
I was about to ask you that. Is that after we just see since October a bull market on the equity market?
Yeah.
If you look at the major European indices and US as well, it's like there was no war, like no energy crisis, no big slowing down ahead of us. So more than 20%. CAC 40 has wiped out any losses for this year. What do you make of that? Is it a good time to sell or to buy?
Well, I think it's probably a good time to hedge for the first start of the year. And again, when I say it was a tricky year next year, probably, again, overall, we're going to expect some positive returns for next year in equities, let's be clear. But I think it's going to be more in the second half of the year, and the first half of the year, we're going to be tricky. Well, obviously, I think there could be some continuation in positive trends. Why? Because, again, the market, is... Some say this is a voting machine. So currently what the market is voting for is the disinflationary trends. So as long as we have good inflation numbers, which means lower than expected, or that continue to validate the fact that the inflation peak is behind us, then I think the market can continue to be pretty positive, because it's gonna be more expecting dovish central banks, etc. The other thing that is also probably a good factor on the short run is the fact that positioning of marginal buyers, let's say the fast money or the hedge funds, the CTAs, have been really at low exposure levels. That's the two positive points: surfing on the macro news flow in inflation, and second, positioning of marginal buyers. You can still have some upside. On the opposite, what makes me worried right now is the valuation, and the valuation of US assets. If you look at valuation of US assets, they are extremely expensive. They are much
compared to expected earnings, because on the long-term average is not that.
Well, if you look at PE, for instance, the PE, the 12 months forward PE at 18 right now, it's the top 25% in history. This is a sharp contrast with Europe, which is at 12. This is the bottom 25%. So if you have no EPS growth on the one hand, you're only left to what? To PE expansion. Then PE expansion, obviously, if you are very expensive right now in the US and you have risk of recession, even though it's a mild recession, then you have not a lot of upward capacity for PE expansion. It's going to be more a European story, I think. So we would expect somehow next year an outperformance of European stocks on the back of more capacity, of more capability to have PE expansion there.
Emerging in this context, you like it? What was your major calls for next year, Florent?
Well, the major call is again, I think, in terms of earnings and of equities. I think I would be very cautious for the first start of the year, so putting some edge for Q1. Then, if we are right on macro and we have a mild recession and recovery, it's not going to be a super strong recovery, but still we could have some expansion. So again, I would be long more European equities versus US. And never mind also in terms of style. The big call we have is we should stick to quality style. Stick to stocks that are able to generate cash flows on a regular basis, that have strong balance sheets, and that will be able to, sustain the mild recession stories, the increase in operating costs, etc. So stick to this style. And last, also stick to value stocks. So again, if you look at the market, there's a huge discount that has not been resolved this year between the most expensive stocks and the most cheap stocks. So this gap is still wide, and I think if history of any guide, there should be a convergence. You should still continue to be long value versus short growth. And finally, if you are running a diversified portfolio, this is also something we've been publishing already last year. If you can look at the slide, I think you should continue to have some, let's say, alternative strategies that are able to have low correlation to equity and bonds. So typically, we like trend-following strategies that are able to diversify very well portfolios. If there's a recession, which is harder than expected, or even though there is a disinflationary trend which is materializing. So
interesting, because this year we have seen that usually we say you buy some stocks to dream and you buy some bonds to sleep well. We have seen this year that none of that was possible. So what you're saying that probably you have alternative strategy to hedge yourself more comfortably. Thank you very much, Florent. Maybe moving to Samy, because a lot of questions usually on banks in this context, and we see this is a rising rate environment and a slowing down of economies. Usually it's not very well, something is good, something is bad. What about banks, Samy, in this environment of rising rates? How do you see that?
So it's a very positive environment for the banking, for banks, not only in Europe, but also in US, in UK, so worldwide, because banks suffered from very low profitability for many years. They suffered from negative interest rates and flat yield curves. And now the situation changed and is still changing. And we are back into positive territory in terms of interest rates. And the profitability for banks is mainly based on the net interest income. And the net interest income still represents the bulk of the net banking income, between 50 to 60% on average in Europe. And sometimes in some countries, in particular in the Benelux, it could represent up to 70%. That is to say, the business model of European banks, is retail oriented. And we expect the net interest margin to be around 2.3% at the end of 2023. And it could represent up to 40 billion euro in terms of net interest income over 2023.
And that will be enough to compensate for the rising cost and provision. And we see a lot of provision on the European banks these days, and same for US, but especially for European banks are very, very cautious on their provision. Is it going to be enough to cover for that?
Yes, I think so, and I hope so, because I think that the net interest income will increase by 15% on average next year, year-over-year compared to 2022. And in 2022, the net interest income increased by between 20 to 25% on average. And some banks have already increased their guidance in terms of revenues and in terms of net interest margin. And if we look at the costs, they increased in 2022 due to inflationary pressure, between 5 to 7% on average. And I think that in 2023, maybe cost will increase between 3 to 5% on average. But on the other side, we have revenues will increase maybe between 5 to 10%, between 5 to 7% on average. And I think that the net interest income increase will absorb the cost increase and also the cost of risk increase. And we expect for 2023 a cost of risk to be around 70 basis points on average.
And what about the asset quality of a bank balance sheet?
So it's a tricky issue on the asset quality because we expect the credit...
Thinking of real estate, a lot of things are,
yes.
are moving
we expect
risky.
the credit quality to deteriorate in 2023. And also the regulator is very cautious because the regulator asks bank to put enough money aside in order to cover risk. But on the other side, we have banks which are very positive for 2023. As I said, they increase their guidance in terms of income. And I think that the stage 2 loans, so we have 3 stages. The first one, everything is good, so no problem. And in the second stage, loans are deteriorating. And if we have the stage 3 loans, that is to say, they are classified as non-performing. And the stage 2 loans are very sensitive to macroeconomic environment. For example, during the COVID crisis, we reached a peak in terms of stage 2 loans, but just after, the decrease also was massive. And we expect for 2023 an increase in terms of stage 2 loans between 150 to 200 basis points on average to a level of 12%. And for stage 3 loans, it's a little bit different because stage 3 loans are lagging. And I do not expect any significant fallout in Europe. And I think that the stage 3 loans will increase, but very slightly, not before the second part of 2023.
So you sound quite reassuring in this slowing down the mild recession that we are seeing. Definitely 2023 is not 2008, as you can see overall on that matter. So maybe to thank you very much, Samy, to conclude this session on rates, markets and banks. And overall this session, globally, what we have is a macro picture, obviously, of a strong deceleration. Make no mistake, this is a strong deceleration is ahead of us. And Dirk was mentioning that before. Recession is ahead in a sense that we are going to see 2 consecutive negative quarters. So this is a technical recession almost in every OECD country. So this is a recession coming ahead for sure. But once again, at the end of 2023, it's probably going to be a level of GDP higher than at the end of 2022. So like Samy was mentioning, this is not for banks, for instance, or what Florent just mentioned. At the end of 2023, probably the equity will be up. Different story in Q4, Q1. We are, you understand, we are quite cautious about the latest move on risky assets. But at the end of 2023, probably some more risk on will be there. And again, 2024, that will be our next rendezvous. But what we do see at the moment is a 2024, which is up, which is more back to normal after this kind of post-COVID, post-war, post-COVID rebound, post-war decline, and so on and so forth. 2024 it might be back to kind of normality, a new normality for inflation with the energy transition, deglobalization, a new normality for growth, but clearly not a long-lasting recession in our view. Any question? Do not hesitate to reach out to your favorite sales or correspondent within the research. You have the Twitter account, you have the website, and you will have a big publication at the end of this week around that. Thank you very much for joining us this morning. Another English session at 3 p.m. this afternoon for those willing to get some more. Thank you very much for joining us.